What if I told you that one of the biggest threats to Bitcoin isn't the Federal Reserve? It's Japan. Not because Japan is buying Bitcoin, but because of something called the yen carry trade, a strategy worth hundreds of billions of dollars that has quietly fueled global markets for years. And if this trade starts unwinding too quickly, Bitcoin, stocks, and even gold could all feel the impact. Let's break it down. Japan has had one of the lowest interest rates in the world for decades. Imagine you can borrow money at almost 0% interest. That's exactly what many hedge funds, banks, and institutional investors have been able to do using the Japanese yen. Here's what they do. Step 1. Borrow Japanese yen at extremely low interest rates. Step 2. Convert those yen into US dollars or other currencies. Step 3. Invest the money into assets that generate higher returns. These include US stocks, NASDAQ, Bitcoin, AI companies, emerging markets, bonds with higher yields. This entire strategy is called the yen carry trade. Think of it as borrowing cheap money to invest somewhere that pays more. As long as the yen stays weak, everyone wins. Now imagine the opposite. The Japanese yen suddenly becomes stronger. This changes everything. The investors who borrowed yen now have a problem. They must repay loans in a currency that has become more expensive. Their borrowing costs effectively increase. To repay those loans, they often need cash. Where does that cash come from? They start selling the assets they own. That means selling stocks, selling crypto, selling ETFs, selling anything that can quickly be converted into cash. This is why a sharp rally in the yen can create selling pressure across global markets. It isn't because Bitcoin suddenly became a bad investment. It's because investors are forced to reduce risk. Liquidity disappears. And when liquidity disappears, prices usually fall. Here's the important part. Not every stronger yen is bad. A gradual appreciation allows investors time to adjust their positions. Markets can absorb the change without panic, but a rapid move is different. If the yen strengthens too quickly, thousands of leveraged positions may need to be closed at the same time. This creates a domino effect. One investor sells, prices fall, another investor gets liquidated. More selling follows. Liquidity dries up, fear spreads. This is exactly how market-wide corrections can begin. The speed of the move matters much more than the move itself. There's another side to this story. Japan is one of the world's biggest exporting nations. Companies like Toyota, Sony, and Nintendo earn a large portion of their profits overseas. When those foreign earnings are converted back into yen, a stronger yen means they receive fewer yen for the same amount of dollars. That hurts profits. It also makes Japanese products more expensive for foreign buyers. This can reduce export competitiveness. That's why Japanese policymakers usually prefer a stable currency. Not too weak, not too strong, just stable enough to support economic growth. If you're trading Bitcoin, don't just watch Bitcoin charts. Watch the macro picture. Keep an eye on USD/JPY, the Japanese yen, Bank of Japan policy decisions, U.S. Treasury yields, Federal Reserve interest rates. These markets are deeply connected. Sometimes Bitcoin moves because of crypto news, but other times it moves because global liquidity changes, and the yen is one of the biggest drivers of that liquidity. A weaker dollar can often support Bitcoin. A stronger yen isn't automatically bearish. The real risk comes from how fast the yen strengthens. If the move is gradual, markets usually adapt. If it's sudden, the unwind of the yen carry trade can force investors to sell risk assets around the world. And that's why one currency on the other side of the planet can end up influencing the price of Bitcoin in your portfolio. If you enjoy macro-driven crypto explanations that go beyond the headlines, subscribe to Stick vs. Crypto. Because understanding liquidity is often more valuable than predicting price.